Treasury yield is the effective yearly interest rate, stated as a percentage that the United States government pays on a certain debt obligation. The annual return that investors might anticipate from owning a U.S. government security with specific maturity is known as the Treasury yield, to put it another way. Treasury rates have an impact on investors' returns on government bond purchases, in addition to how much the government has to pay to borrow money. They also have an impact on the interest rates that firms and consumers pay on loans for the purchase of property, vehicles, and equipment. Treasury yields also reflect how investors view the future of the economy. The more long-term U.S. Treasury bond yields are above zero, the more optimistic investors are about the future of the economy. High long-term yields, however, might also be an indication of escalating inflation expectations. But what does the rising Treasury yield mean to investors? How does it affect them? Make sure to stay tuned until the end to find out. Treasury rates have been steadily declining since the early 1980s, but they're now climbing at the fastest rate we've seen in decades. The 10-year Treasury rate is now 3.589% after rising on Monday from an all-time low of under 0.55% in July 2020. What does this mean then in everyday language? In essence, Treasury yields represent the interest rate on U.S. government bonds. Because they're completely supported by the security of the U.S. government, they're regarded as being about the lowest risk investment you can make. Since they're as close to zero risk as you can get from an investing standpoint, U.S. Treasury yields are frequently referred to as the risk-free rate in the investment community. To put things in perspective, these bonds were essentially paying nothing a few years ago. They were still giving a negative real return even when inflation was at low, normal levels. These bonds are paying yields right now that don't seem at all awful. Given the current rate of inflation, interest rates remain negative in real terms. As rates continue to increase and inflation continues to decline, that could alter in the upcoming months. While all of this may appear to be excellent news for investors eager to purchase bonds, it's not all roses. Due to the inverse relationship between the price paid to buy a Treasury bond and its yield, bonds have actually had some of their poorest returns ever. So if yields increase, prices decrease. Confused? No need to worry. We'll explain. Why do bond prices fall as yields rise? Okay, so this might have been a throwaway remark in a news item. Bond prices drop when yields rise, or words to that effect. This doesn't seem to make much sense at first. After all, in practically every other investment type, if the yield increases, the asset price increases as well. A stock's price will usually increase over time if it continuously provides a higher dividend yield. A property's price will eventually rise if the rental income does. What then are bonds for? It all depends on interest rates as well as the fact that these bonds typically have very long terms. So the first thing to remember is that they can be bought and sold amongst investors once they've been issued, but they'll remain in force until the maturity date. These can have terms as short as 2 years, up to 10 years, and as long as 30 years for U.S. Treasury bonds. Let's now look at an example to show how the connection between bond prices and yield functions. Consider that the U.S. government issues a 10-year bond with a 3.5% yield, which is roughly the same as it is at the moment. These bonds cost $1,000 to purchase and will generate an annual income of $35 for you. $1,000 times 3.5% equals $35. Imagine that over the course of the following year, interest rates rise and the yield on the new 10-year Treasury notes increases to 5%. Imagine that your friend Gary wants to purchase a 10-year Treasury bond. Gary can purchase a recently released bond with a 5% yield, which would earn him $50 a year on his $1,000 investment in order to buy some stocks instead of bonds. You happen to be willing to sell your bonds. Gary's probably not going to be interested if you try to sell him your bond for what you paid for it. After all, he only receives $35 a year for his $1,000 investment in your Treasury bond, as opposed to $50 for a newly issued bond. What do you do then? Well, matching the yield and offer for new bonds is the only way you're going to find a buyer for your bond. As a result, in this case, you would have to reduce the purchase price to $700. That is so because $35 divided by $700 equals 5%. Your bond now meets the yield of newly issued bonds and the market price at a price of $700 in the secondary market. Having said that, it's critical to remember that this volatility has no bearing on the fundamental risk associated with bonds. After all, in this case, you could just keep your treasury for the entire 10 years, at which point the US government would reimburse you for your initial $1,000. What effect does this have on treasury yields? Bond prices have decreased considerably over the past year or so as a result of this inverse relationship. In an effort to reduce inflation, the Fed has been sharply raising interest rates, which has resulted in a significant rise in yields. Bond prices decline when rates rise, as was demonstrated in the aforementioned example. Bond prices decline at a greater rate when yields rise. Due to an ISM report for November that was better than predicted, yields have increased this week. This study looks at a manufacturing index that measures orders, output, employment, and inventory for industrial goods. Prior to the eventual client sale that is measured by GDP, it can provide an indication of the level of economic activity that is in the works. Since the news came in stronger than expected, rates have gone up on the belief that the Fed will keep up its aggressive rate hiking strategy. While inflation is continuing to decline, the economy is still fairly resilient, raising some questions about how the Fed intends to approach the upcoming FOMC meeting. What are the prospects for Treasury bonds? What can we anticipate for U.S. Treasury yields over the ensuing 12 months given all of this? Jerome Powell, the head of the Fed, has made it clear that he's taken issue of inflation seriously. The Fed intends to exert all of their authority to bring it back down to the target range of 2 to 3%, which will probably necessitate many rate increases from the current level. Surely, you're aware of what it now entails. It implies that interest rates will increase further, yields will increase, and bond prices will decline as a result. Therefore, it is likely that the bond market will continue to see unusually high levels of volatility in the near future. On the other hand, there is a significant likelihood that the Fed will attempt to reverse its strategy and start bringing rates back down once inflation is under control. This will result in lower yields, which will raise bond prices. In either case, it'll likely be some time before there is any meaningful progress in this direction. For investors, what does this mean? It implies that the conventional 60-40 investment portfolio isn't currently operating as it should. Bonds and treasuries are typically regarded as protective investments with moderate volatility, although at the present, their volatility is higher than usual. Looking at several alternatives in the near term could be necessary for investors who want to keep their volatility low. This could imply shifting funds to investment assets with a higher likelihood of meeting low volatility targets. What are your thoughts on Treasury yields? Let us know in the comments section. And if you enjoyed watching this video, then please make sure to like, share, and subscribe to our channel for more such amazing videos.